It's 9 o'clock, so we'll go ahead and get started. So good morning, my name is Jim Porch. I'm Chairman of the Maryland Transportation Authority Board, and I hereby call this meeting of the MDTA Board to order at 9 a.m. This morning we're having our meeting in person at MDTA headquarters, and in accordance with the live streaming law, this meeting is being live streamed on the MDTA Board webpage. I would like to say welcome to the members and staff who are with us today. As a reminder, I ask anyone who's in the room with us this morning to refrain from speaking unless you're presenting or answering a question, to avoid background noise on the live stream. And for the record, I'd like to state that member Lee Gaines and Executive Director Will Pines are joining us via conference call. In addition, Chief Operating Officer Joey Sagal will be presenting agenda item number 15, the Executive Director's Report. And there are no members of the public, no elected officials, no media who have pre-registered to comment at this morning's meeting. For those who are watching this meeting via live stream, we have posted the materials for today's meeting on the MDTA Board webpage so that you can follow along if you would like. We will now begin with today's agenda. The first order of business is the approval of open session meetings from October 27th.
Move for approval, Mr. Chairman.
Been moved and seconded for approval. All those in favor?
Aye.
Any opposed? The ayes have it. Next order of business, approval of closed session meetings
So
for
moved.
October 27th. Been moved for approval
Second.
and seconded. All those in favor?
Aye.
Any opposed? Ayes have it.
Don't forget
All right. Next order of business is the approval of contract awards. Donna DeCerbo?
Good morning, everyone. For the record, Donna DeCerbo, Director of Procurement for the Maryland Transportation Authority. This morning I have 4 contracts to provide for approval. The first contract is HT 2709, the envelope and switchgear replacements at the Baltimore Harbor Tunnel vent buildings. The work is located at the Fairfield and Canton vent buildings. The scope of work includes removal of existing building facades, intake louvers and roofs with installation and new architecture, precast concrete walls, etc. We did re-advertise this contract on November 5th of 2021. We received 4 bids. 1 bid was determined not reasonably susceptible for award. We are recommending award to W.M. Schlosser and Company for $67,877,000. There was a 20% MBE goal and a 1% VSBE goal for this contract. The recommended awardee to Schlosser is meeting or exceeding those goals. We did receive a protest on this contract from the non-responsive vendor, and the protest period has passed and no appeals have been made.
Okay.
Happy to answer any questions.
All right. Any questions for Donna?
You may want to explain about the bid. Could you explain about the bid
Oh, I'm sorry.
Explain about the bid protest for the folks who weren't in the Capital Committee.
Okay, so the, hold on. So Chanbro Corporation was the lowest, apparent lowest bidder, but they were deemed not reasonably susceptible for award because they failed to meet the required MBE goal and did not request a waiver for the remaining partial of that. They also exceeded the mobilization and demobilization lump sum price that was not allowed to be exceeded in the bid. Therefore, they were found not reasonably susceptible for award. As stated, they did protest. We denied the protest. They did not appeal to the MSBCA, and that appeal period has passed.
Move for approval.
And that's not curable.
Correct. It's not curable.
Okay.
Move for approval.
It's been moved for approval
I'll second.
and seconded. Any further discussion? Hearing none. All those in favor?
Aye.
Any opposed?
Aye.
Ayes have it. Go ahead, Donna.
The next contract is KH 3031 for the noise wall along I-95 south of Calvary Road. The work is adjacent to the JFK Memorial Highway in Harford County. We received let me count these. These look like more than 8 bids, which is very good. We're great to have all that competition. And we're recommending award to the 6M company for $9,819,000. This was advertised on August 1st of 2022. It had an MBE goal of 20% with a 1% VSBE goal, and the recommended firm, the 6M company, is exceeding the goal at 20.01% and meeting the VSBE goal. There was no protest for this contract, so we're recommending award to the 6M company.
Any questions for Donna?
Move to approve.
Second.
Move for approval and second it. Any further discussion? Hearing none. All those in favor?
Aye.
Any opposed?
Aye.
The ayes have it.
I need to make one correction on this contract and the contract before that. These are contingent approval, pending the sign-off on the
BPW.
approved MBE plans,
Okay,
MBE plans and signed contracts. Thank you.
that's fine.
Okay?
Yep.
Next contract, MT 00-2010-742, advertises MT 3154. This is the fire alarm and suppression, preventive maintenance and repair and fire alarm monitoring contract. This is at all of our facilities. We received 4 bids. We're recommending award to Advanced Fire Protection System in the amount of $1.340 million. This was advertised with no goal and no VSBE goal due to the single element of work. No protests were received, so we're requesting approval of this contract.
Any questions?
Move for approval.
Second.
Move for approval and second it. Any further discussion? Hearing none. All those in favor?
Aye.
Any opposed? Ayes have it.
Okay, thank you. The next and final contract is J01B36000006 for open text additional licenses. This was a procurement done as a small business reserve off the commercial off-the-shelf master contract.
Nice.
This was a purchase order RFP. We received 3 bids. We're recommending award to Applied Technology Services in the amount of $308,763. There were no MBE goals or VSBE goals due to the single element of work, and no protests were received.
So it was bid as small business reserve?
Yes, sir.
Okay. Any other questions for Donna? All right.
So move. Approval.
Move for approval and second it. Any further discussion?
Second.
Hearing none. All those in favor?
Aye.
Aye.
Any opposed? Motion carries. Okay,
All right.
so that completes the contract awards. Now we have the update on procurement report on all open contracts. It's verbal. Donna, you're still up.
Yes, my final report is for our quarterly report of all open contracts in accordance with the operating agreement. We have at this time 13 open MOUs, or memorandums of understanding, for $8.1 million. We have 85 architect and engineering contracts in the amount of $909 million. 51 construction contracts in the amount of $1.8 billion. 25 maintenance contracts for $30.4 million. 23 service contracts for $31.4 million. And 34 IT contracts in the amount of $154 million. For a total contracts, open contracts of 231 open contracts in the amount of $2.9 billion. Of the $2.9 billion total contract amount, $1.6 billion has been paid, $901 million are obligated, and $401 million are remaining and have an open contract balance. We've been quite busy. Any questions? All right.
Any
Thank you for your
questions?
time.
No? Okay.
You.
Thanks for the update, Donna.
You're welcome.
Next order of business is approval of the quarterly review of investment strategy and benchmarks. Alan Garman.
Great. Good morning. Thank you. This is the quarterly review of investment strategy and performance. This item was discussed in greater detail with the Finance Committee at the recent meeting. There are no changes recommended in strategy or benchmarks at this time. We're here to seek approval for a continuation of the investment strategies and benchmarks for the current quarter. I guess one point to note is that the longer duration strategies employed generate greater return volatility, particularly in this rising rate environment, but they're expected to generate higher average annual returns over multi-year periods. The key points for this meeting are that for the trailing 12-month period through September, the investments conform to investment policy limitations, and our portfolio structuring by account adhered to board-approved strategy and should remain consistent, and that's despite the return volatility associated with the rising rate environment. In terms of investment strategy, the agency employs two broad strategies. One is a matched funding approach, and the other is a total return approach. A longer-term strategy is permitted in the trust agreement, and it's recommended in the investment policy as a consideration for our longer-term reserves. And given that our unencumbered cash balance that's held in the longer-term reserves is very long-term in nature, it's prudent to consider that longer-term approach for those accounts. Of the $820 million portfolio at the end of September, a bit more than half, about $477 million, is invested on a matched funding basis. So those are monies in our operating account, our debt service accounts, and our capital construction accounts. So that means that those investment maturities typically are less than a year, and they precede or coincide with that projected spending. The remaining amount, $343 million, that's held in the general and M&O reserve accounts. Those are our longer-term reserves that are prescribed in the debt policy, and they're managed for total return, and that's with consideration of the risk or volatility and return trade-off associated with those longer-term structures. Again, those portfolios should benefit from higher average annual returns over multi-year periods, but they will exhibit greater return volatility. These duration targeted portfolios maintain a consistent structure, and management does not recommend trying to time the market or anticipate market rate changes. The two reserve accounts, the general account is benchmarked to a 1 to 5 year index, so the maturities are structured essentially staggered out to 5 years, from 3 months to 5 years. The effective duration is about 3. The M&O reserve has staggered maturities out to 15 years. The average maturity is about 7.5 years. I guess as evidence that management does not attempt to time the market or make that recommendation, the general account strategy has not changed in many years, and the M&O reserve strategy has been consistent in the last 2 years since 2020. So to close, we're recommending a continuation of investment strategy and benchmarks for the upcoming quarter. Are there any questions?
Any questions for Alan?
I do have a comment, Mr. Chairman. As Alan said, this strategy is supported by the investment committee, also the finance group, and our advisors, as well as the finance committee also feels we should continue this course.
Yeah, well, I think everybody on the board has tremendous confidence in Alan and his technical expertise. So, okay, with that, if there are no further questions, I'll entertain a motion.
I'll
So
make a
moved,
motion.
Mr. Chairman.
Been moved for approval and seconded. Any further discussion? Hearing none, all those in favor?
Aye.
Any opposed? Ayes have it. Thank you, Alan.
Thank you.
Okay, next we have the updated traffic revenue forecast update, a review of the annual updates to the traffic and revenue forecast for all facilities. Chantel, how are you today?
I'm fine. How are you?
Good.
Very good. Good morning. Good to see you.
Yeah.
Good morning, everybody. Good morning. So today I will be presenting the annual traffic and revenue update. You all may recall that every fall we receive an update from our independent traffic and revenue consultant. So I'll be providing a high-level overview. If you turn to the slide presentation deck in your materials, I'll be working from that today. So specifically, if you turn to slide 2, you'll note that the current forecast totals $4.5 billion over the fiscal year 2023 to 2028 timeframe, which is down 1% from the previous forecast. The majority of the reduction is in fiscal year 2023 due to the customer assistance plan. Several of the key forecast assumptions include a slightly more negative impacts from COVID-19, particularly on the congestion managed facilities, the continued processing of the backlog, that NOTD collection rates will return or trend back to historical rates in the next few years, that civil penalty collections assumed on NOTDs prior to fiscal year 2023 due to the customer assistance plan, that no civil penalties will be assumed with respect to that. And then lastly, that new vehicle classifications are expected to go into effect in fiscal year 2023. So turning to slide 3, system-wide, you'll note that there is a reduction of $50 million over the period. The key forecast drivers include the fiscal year 2023 reduction due to the customer assistance plan, as well as adjustments due to the lingering impact of COVID-19 on the ICC and ETL facilities. With respect to legacy facilities, which is at the bottom of the
Yeah,
slide.
Mr. Chairman, I think there was a little problem with it.
It's down roughly $12 million. Some of the key drivers include that the passenger vehicle revenue is impacted in the near term due to the processing of the NOT backlog, as well as construction impacts on the FSK and BHT facilities. Additionally, commercial vehicle performance is expected to taper off in the next few years as pandemic-induced trends tend to wane and the economic uncertainty with high inflation, gas prices, and the cost of goods are also impacted. Turning to slide 4, with respect to the ICC and the ETLs, revenues are down approximately $30 million. Key drivers, as previously mentioned, the lingering impacts of COVID-19, particularly on these facilities. Additionally, there's the slight reductions, however, in revenue are offset by slight revenue growth, which is expected on the I-95 ETL beginning in fiscal year 2026. And this slight increase is largely due to the fact that there's some projected traffic increase on the JFK and FMT facilities, which is also expected to impact this facility as well. Additionally, there are some positive impacts on the ETL starting in fiscal year 2026 due to the opening of the first phase of the northbound extension, as well as the inclusion of the I-695 direct connector ramps. Moving to the bottom of the slide, administrative toll revenue is down $9 million. And the key driver with that, again, is the fiscal year 2023 reduction associated with the customer assistance plan. However, the remaining years of the forecast on a net basis remain slightly higher due to higher passenger car transactions. Turning to slide 5, it provides a comparison of the previous forecast to the most recent forecast. You'll note over the entire period, there's a $41 million revenue reduction compared to the previous forecast. The variation in the near term is mostly due to the customer assistance plan. In the immediate years of the forecast, that's impacted by changes in the construction timeline for certain legacy facility projects. And the out years remain positive over the prior forecast following the completion of those various construction projects, as well as the addition of the I-695 direct connector ramps. So overall, the forecast remains very similar beyond fiscal year 2023, remains very similar to the previous forecast. And then finally, not surprisingly, there's some economic uncertainty remains as it relates to commuter habits, as well as overall economic conditions. And that concludes the high-level update of the forecast. Thank you.
I guess, when I read through this economic, the whole teleworking thing, sounds like, though, we're still okay. I think Deb's been telling us sure I was reading it right.
Okay. Any further questions?
Member again, Jenny. For the record, Deb Sharpless, MDTA CFO. As we progress through the rest of the agenda items, one of the items is the official financial forecast, as well as Chantel doing the revenue sufficiency. So I think that's where you can see that, the decisions that you're making are within our financial policies.
Yeah, and I agree, and I was kind of looking at all the data that we could receive, so thank you.
Any further questions? No? Okay, thank you for the update.
Thank you.
Thanks for smiling.
Next order of business is the approval fiscal year 2024 preliminary operating budget, approval for the preliminary operating budget. Jeffrey Brown.
Okay, good morning. For the record, my name is Jeffrey Brown, Budget Director for the MDTA. I'm here today to present for contingent approval of the fiscal year 2024 budget. It's contingent upon DBM rates, which can change between now and the beginning of the year, which may change it slightly. For the fiscal 2024 budget is $391.4 million, which represents a $4.2 million or 1.1% increase versus the fiscal 23 budget. I'm comparing the budget to the MDTA financial forecast of June 2022. The budget is $4.5 million or 1.2% more than projected. The key driver for this increased spending is the cost of living adjustment of 4.5% for all state employees effective November 1st. In understanding the budget, we break it down into three major buckets: mandated increases, discretionary additions, and discretionary reductions. The mandated increases had a $13.8 million increase, and the primary driver is the personnel expenses associated with the COLA. For instance, a 4.5% COLA that was just mentioned, as well as a 5% COLA for the police in fiscal year 24 account for an $8.4 million increase. At the authority of the MDOT Secretary, the MDTA follows suit with any actions taken by DBM for all other state employees. In addition, retirement costs for both civilian and police were up and accounted for a $3.4 million increase. Step and grade increases accounted for $1 million, and Social Security increased $1 million, again primarily associated with the personnel cost increases. The operating budget includes $8.9 million in additional discretionary spending. There's three main drivers for this. They're in engineering, building repairs and maintenance, and turnover. For engineering, it was a $3 million increase. Increases are due to on-call consultant salary and inspection cost increases, an alignment with actual cost design activity, and increased environmental asset construction drove those costs. Building repairs and maintenance are up $2.2 million. This reflects a gradual return to pre-pandemic levels. Additional turnover showed a decrease or a smaller credit, which equates into a larger expense of $1.6 million. This is the net effect of higher salaries offset by a reduction in turnover rate as we anticipate to continue to fill vacancies. Management studies and consultants were up $700,000. There's several reasons. There's additional architectural and engineering contracts for the asset management and support services division, in addition to some other studies such as workforce optimization modeling and customer experience mapping. Salt and snow materials increased $300,000. This is just more in line with what we expect the normal winter spending levels. Insurance was up $0.2 million due to increasing rates in the marketplace, and Maryland State Police had a $0.2 million increase, primarily due to overhead tied to the COLA increases. The remaining $700,000 are spread across various sub-objects. Not one of them is more than $100,000, all in the $100,000 range, and there are things for such as rising diesel costs, some additional association dues and audits and things of that nature. Moving on to the discretionary reduction, those totaled $18.5 million, and there were two major drivers: Easy Pass service center costs and purchased vehicles. For the service center costs, it was a reduction of $11.2 million. This is due to the removal of the backlog, reduced staffing requirements, and expected lower contractual rates. Purchased vehicles decreased $4.5 million. In fiscal year '23, we're anticipating the purchasing of the collective bargaining vehicles for the police, which will not obviously reoccur in fiscal '24, so that really is driving the reduction. Miscellaneous payroll adjustments is lower by $1.3 million due to the elimination of a COVID-19 premium pay. Other replacement equipment's down $0.6 million as we are anticipating the purchase of PPE equipment in fiscal '23, which we obviously don't have to return in '24, as there you have typically 10-year lifespan. Additional maintenance and equipment's down $0.4 million. Again, we had key purchases expected in the prior fiscal year, which won't repeat in this fiscal '24, and advertising was down $0.2 million. That concludes my presentation. I'd be happy to take any questions at this time.
Questions? No? Okay. With that, I'll entertain a motion for approval.
So move.
Been moved.
Second.
Been seconded for approval. Any further discussion? Hearing none. All those in favor?
Aye.
Any
Aye.
opposed? Ayes carried. Thank you, Jeff.
All right, thank you.
Next order of business is approval fiscal year 2023 through 2028 Consolidated Transportation Program, better known as CTP. Approval of the 6-year capital budget. Jeannie,
Good morning.
how you doing?
I'm Jeannie Marriott, the Capital Program Manager. And today I'm asking for your approval of the proposed final fiscal year 23 to 28 CTP. And this was recommended for approval by the Capital Committee on November 3rd and by the Finance Committee on November 10th. The 6-year 23 to 28 budget and the proposed CTP is $2.7 billion. The proposed CTP reflects a net increase in the 6-year fiscal year 23 to 28 budget of $52.6 million. If we'll turn to attachment 1, look at a breakdown of the changes comparing from the draft to the final. I'm going to look at the column where the highlighted items are. It says total 23 to 28. In the first section, we see that the Nice Middleton Bridge 6-year budget increased by $15.8 million, which you can see in this is all rollover. You can see that from the first column where the 22 rolled over into the 23 to 25 period. The second section is the I-95 ETL Northern Extension, and including reserves, which are only for that group of projects. There was an increase of $9.2 million. Section 3 is the remainder of the CTP, except for the Nice Middleton Bridge, the I-95 Northern Extension, and the reserves. And that increased by $107.9 million. Line 4 is allocated and unallocated reserves. There was an $80.3 million decrease. Section 5 is 3 and 4 added together. So you can see that there's a $27.6 million increase of everything except for the 2 main projects that we're working on. And line 6, it's a $52.6 million increase. If you look in the 2022 column, see that there was a $52.4 million of funds that we expected to spend in '22, but we did not. So that's rolled over into the 6-year period, and that accounts for pretty much all of the $52.6 million increase. If we go to attachment number 2, you can see changes from the draft to the final that are broken down by project. In the first section, we see that there's 1 enhancement and 3 system preservation projects added for an increase of $6.3 million. The second section, 2 projects were modified to reflect bids received for a net increase of $15.9 million. 2 projects were modified to add the construction phase for a net increase of $45.7 million. In the next section, there was 1 completed and 1 deleted project for a net decrease of $15 million. And then starting on this page and continuing to page 4 are 112 active projects modified due to cost changes and cash flow adjustments. If you look at the bottom of page 4, you see that those resulted in a net increase of $80.1 million. And on page 5, at the top of the page, is a breakdown of the reserve changes. And then the last section is a summary of the changes from the draft to the final. The first item, the budget changes to the projects, is $132.9 million increase, and that's the total of everything that you saw on pages 1 through 4. And then with the reserve decrease of 80.3, that brings us back to the net increase of $52.6 million from the draft to the final. Then attachment number 3, where are the projects? This shows where the money is being spent by facility. The Kennedy Highway section is the largest at 40% because it holds the I-95 ETL Northern Extension projects. Then if we go to attachment number 4, what are the categories of projects? See that the largest section on this one is the safety and capacity improvements because most of the I-95 ETL Northern Extension projects are classified as safety and capacity improvements. And I'd be happy to answer any questions you may have.
Any questions for Jeannie?
Chairman, just one question. Are you seeing any, maybe this is for Jim, that any increases as far as with the current state of the economy? I mean, and as far as shipments and that type thing, you seeing any real change as far as amounts it's already budgeted? Jim, you seeing any of that at this point?
Oh,
I couldn't answer.
Thanks. Jim Harkness, Chief Engineer for MDTA. Member Cox, we are, of course, seeing that, contractors are struggling with pricing. Obviously, we've had contracts that have bid well in advance of this, so we're working as closely as we can with contractors on understanding the struggle of pricing and delivery on availability of items and even workforce. So we are working with them on that. So far, our bids, we've been able to kind of go off of what we know on our estimating. So we've been able to make adjustments in our budget, which is reflected in what is before you today here to approve. So we're trying our best to take a shot at capturing as well as we can the current market conditions. And as you saw from the project earlier, we've had some where we've not done enough to capture it, and then there's ones where we're overestimating. So we're still getting good competitive bids on some of our projects, and so we're reflecting those in the budget as to our best ability. But obviously, as things change in the coming months, we can only do so much.
Thank you. Appreciate it.
any other questions?
I'll move for approval.
Okay, it's been moved for approval.
Second.
And seconded. All those in favor?
Aye.
Any opposed?
Aye.
Motion carries. Thank you, Jeannie. Jim?
Thank you.
Next order of business is the approval of fiscal year 2023-2028 fiscal forecast, approval of the 6-year financial forecast. Chantel Green.
Back with this month.
Welcome back.
Yes. Thank you. Appreciate it. Again, I am Chantel Green, the Director of Finance here at the Authority, and I am here to present the fiscal year 2023 to 2028 financial forecast for your approval. You'll note that throughout the forecast period, the Authority complies with all of its financial goals and legal standards, and that no toll increases are needed in the near term. The primary differences between the forecast that's before you today and forecast that was presented back in June are outlined beginning on page 2. First, there is a $33.2 million reduction in revenue throughout the forecast period. As previously discussed, the decline in revenue is primarily due to a reduction in anticipated toll revenues over the forecast period. Next, the operating budget expenses increased by $26 million throughout the forecast period. And as Jeff noted, that's mostly due to salary increases that are compounded in future years throughout the forecast. Capital expenses remain flat throughout the forecast period. As Jeannie just noted, the projected increase in the forecast is simply due to the rollover of unspent funds from fiscal year 2022 into subsequent years in the forecast. And lastly, bond issuances increased by $36 million over the forecast period, and that's due to a decline in net revenues, which results in less pay-go or cash funding available for capital spending. And with that, that reflects all of the major changes in the forecast from June, and I'd be happy to respond to any questions. Thank you.
Any questions for Chantel? Hearing none, I'll entertain a motion.
So moved.
Then moved. Second. And seconded for approval. Any further discussion? Hearing none. All those in favor?
Aye.
Aye. Any opposed? The ayes have it. Thank you again, Chantel.
Thank you.
And looks like you're still up. Update on the biannual review of revenue sufficiency and review of revenues as required by the MDTA Board operating policy. Chantel, again.
Thank you. As I always tell the Finance Committee, this is typically a brief update. As you noted, Mr. Chairman, the board operating policy requires a biannual review of revenue sufficiency to determine if the current rate and fee levels are appropriate based on expected levels of spending. The financial forecast that was just presented to you shows that the current tolls, rates, and fees and discounts are sufficient in the near term to meet forecasted spending and all of our legal requirements. And that completes my update, Mr. Chairman.
Wow. That's a quick update. Any questions?
That's why she's smiling.
Yeah, you're getting really efficient at this, Chantel.
Thank you.
Well, thank you very much.
Thank you.
Next order of business is the update first quarter operating budget comparison and review of actual versus projected for FY '23 operating budget and spending. Jeffrey Brown. Back up.
Back up.
Okay, again, for the record, my name is Jeffrey Brown, Budget Director of the MDTA, and I'm here for the, what's our typical quarterly update for the budget versus actual performance. In this case, is for the first quarter of fiscal 2023. As of September 30th, 2022, 11% of the budget was spent compared to a target of 23%. All objects were at or below the targeted spending levels. Three primary drivers for this performance are personnel vacancies, seasonality of expenses, and first quarter accruals. The last two, seasonality and first quarter accruals, are kind of typical for this time of year, and you'll hear kind of a lot of the same explanations as this early in the year, and the timing of invoices tends to drive a lot of the variances that you see. Moving on to objects 1 and 2, it is below budget at a 19% spend. Employee vacancies drives this performance for this object. For communications, object 3, we're below budget at a 7% spend. This is primarily driven by one invoice, the state radio system invoice in object 0305. Again, that occurs once a year, has not occurred, so we do expect this to come back to budget. Travel is below budget at 13% spend. Again, this tends to be somewhat lumpy. We do expect this to be on budget. Fuel and utilities, object 6, is at a 10% spend. Main driver, electricity 0620, is below budget at 9%. We do expect this to increase somewhat over time due to the nice bridge and the expected catch-up in some delayed billings. So again, we expect this to catch up, but to be on budget. Motor vehicle operations and maintenance, object 7, is below budget at 14%. This is heavily dependent upon when vehicle orders come through. Again, at this point, we don't see any reason that it will be off budget. Contractual services, object 8, is below budget at a minus 2% spend. We'll get into a little bit more detail, but that's primarily accruals is driving that. Going into a little bit more detail, advertising and engineers are both well below budget at 1% and 3% spend. Again, timing, when the work actually occurs, things of that nature, we're expecting this to be on budget. Equipment repairs and maintenance is kind of the flip side. It's at a 91% spend, but we did have an IT storage and blade service maintenance billing come through. It happens once a year. Again, more timing, we expect this to be on budget at this point. Building repairs and maintenance is at 9%. Again, expected to be on budget. Janitorial services is over budget with a 31% spend. Billing delays have been driving this. We've been paying some fiscal 2022 bills in '23. This is one item that we'll have to keep an eye on that may have some budget implications depending on how much delayed billings come through. But at this point, can't tell, but it's something that we'll have to keep an eye on. Education and training is below budget at 4% spend. Again, timing, lots of times things like tuition reimbursements happen at semester end. So at this point, we do expect this to be on budget. Studies, management studies at 5%. Again, timing, we do have studies on board. We do expect this to be on budget. The primarily IT objects, which is 841 through 869, are collectively at 16% spend, so that's closer to budget. Again, we don't expect any issues. And other contractual services at 2%. There was a coding error. Again, we expect this to be on budget. Supply and materials is at a 13% spend. You look through roadway maintenance materials and salt, again, highly seasonal items, more heavy in the winter. At this point, we don't have any issues or expect it to be over budget. Ammunition is a 61% spend. We had the annual TASER contract come through in the first quarter, so that accounts for most of the variance in that object. And transponders are at a 10% spend, but again, expected to be on budget. Object 10, replacement equipment's at 21% spend. You have kind of the flip side on two different objects. Replacement equipment is only at 1% due to timing, and other replacement equipment is at 63%, and that's because we did do the purchase of some PPE equipment, which again, one-time expense. We don't expect any issues with regards to the budget. Additional equipment is at 7%. Again, the timing, we don't have any issues with this. And finally, object 13 is at 1%. Again, there's one large invoice typically for insurance that occurs once a year, has not occurred yet. Don't expect it to be an issue at this point. So that concludes my presentation. I'll be happy to take any questions at this time.
Okay. Any questions for Jeff? Anything? I hope you stay at 0 for salt usage.
I'd be happy with that.
That's what I'll say.
I'd be happy.
Let's just make that a board decision.
Yeah, board decision. We have a vote on it, right? Yeah, that's great. I wish we could control it like that, but unfortunately. So, okay, great. Thank you, Jeff, for the update. Next order of business, update of first quarter capital budget comparison, review of the actual versus projected capital budget. Jeannie Marriott.
Okay, so I'm here to update you on the status of the actual fiscal year '23 capital spending against the fiscal year '23 capital budget and the fiscal year '23 to '28 draft CTP. And this information was presented to the Finance Committee on November 10th. As of September 30th, 11.9% of the fiscal year '23 capital budget was spent as compared to the targeted spending level of 25%. The total budget for fiscal year '23 is $556 million. The actual spending through the first quarter was $65.9 million. The first quarter percentage is typically low because there are outstanding accruals for work completed in fiscal year '22. 82 of the 91 projects budgeted in fiscal year '23 were within the acceptable spending limits of 0 to 50%. Due to normal lags in invoicing, a plus or minus 25% threshold was determined to be reasonable. If you turn to attachment A, there were 10 projects that were budgeted over $11 million in fiscal year '23 in the draft CTP. And of course, our Lyce-Middleton Bridge, which is winding down, still has the highest amount for fiscal year '23. And also wanted to point out that there are 4 ETL northbound extension projects, and elsewhere these are reported as a group of 26 projects, but for this particular report, we do look at the individual projects. So those add up to $369 million budgeted. 51.6 million was spent, which puts these 10 projects at 14%. And I'd be happy to answer any questions you might have.
Okay. Any questions for Jeannie? All right.
Figure 1, which is attached. Commercial traffic continues to outperform pre-pandemic levels, which can be seen at the same place in the CDM report. And system-wide transactions and revenue exceed the forecast by 2.8% and 7.7 million respectively. However, when we adjust for timing differences, we are exceeding the forecast by 4.3 million or 2.3% for this first quarter of July through September. Now what?
Excuse me, Deb, Chairman, our live stream went down. We need to pause the meeting for a few minutes.
It's down?
Yes, our live stream.
Natalie, do I start completely over?
Yeah, I would start over.
Okay.
So for all those listening out there, since you can't see us, apparently we have some technical difficulties with the video port.